Good afternoon, everyone. Welcome to my last silver update on this hedge margin issue because it's become so controversial, but I'm just going to have to agree to disagree with John from Stellar Concepts. I think he's mostly right, but I just see something a little bit more there, and so I wanted to share with you my latest information that I have here. What you're looking at here, these are the new rates as of Monday the 9th. Now there's two rate requirements, and the CME has expanded these categories quite a bit over the years. I'm going to cover that in just a bit. But you can see we have speculative margin requirements, and then we have hedge or member margin requirements. So first of all, you need to keep in mind that when they say this is just speculators, well, no, we're not talking about speculators. We're actually talking about hedgers. So these margin increases are on hedgers, not speculators. Yes, they raised them on speculators as well, but the main margin increases that we're concentrating on are on the hedgers. So that's an important concept to understand, and there's quite a bit of controversy as to who is actually a hedger in the first place. Now, traditionally in the past, in the gold and silver markets, the bullion banks had been considered to be hedgers because a hedger basically is either in the metals is either a miner or a bullion bank, somebody who actually has the physical metal. So it's not considered as risky as a position because they can always just simply make delivery. And so that gets into the whole Ted Butler thing and all this stuff. I don't think the bullion banks have any silver, so I don't think they are bona fide hedgers, and I don't think that they should be allowed to be short without proving that they're hedgers. At least they should apply the speculative limits to them instead of the hedging limits. But that's a whole other topic. So this is the latest information put out by the CME about Monday's rise, and as I showed you yesterday, I tried to do a percentage analysis of daily movements based on the SLV price and how that showed that the recent moves by the COMEX were not justified, by the CME were not justified based solely on volatility and price moves. Now I want to continue in that vein with another sort of data set that I put together here. First of all, I want to show you the two things I got it from. The first is this is a link that was provided on the CME's website, and I'll give you this link, which is a summary of the margin requirement increases over the course of 2009 and 2010. So that's kind of valuable information. Now I had to painstakingly piece together using this, and the other piece of information that I used is I found a file on the internet that had been put out by the CME prior to that compiled all of the margin changes between 2000 and 2008 for all of the commodities. So if we go to silver here, we can see there's a list of the margin changes between, this only goes back to 2004 to 2008. So using this and the other document, I compiled my own document, and it was painstaking because I had to compile some of the dates. I had to find them from news announcements. There's no real good place to get this data, and I'll make this if you want me to mail this off to you, I'll email it to you, but I couldn't find this data anywhere else, so I had to compile it by hand. So let me give you an explanation of this chart. What this is every margin change, not every margin change is an increase, so this is every margin change between January 9th of 2004, and which May the 9th, which will be tomorrow, including that newest change that they're pushing through. So first of all, I compiled that list of all the margin changes. Then I went ahead and populated the price of silver at each of these dates that the change was made. Then this value column is the 5,000 times the price of silver at the time. So that gives you the total value of the silver contract. In other words, how much money you'd have to put up in total to purchase 5,000 ounces of silver when it was at that price. And this final column is the percentage of this margin requirement. How much of a percentage of the total value of the contract is this? And this is the main number I want to look at, because what we want to analyze is to see if the CME's margin requirement changes are in fact for the purpose of doing what they say they are, or if in fact they're actually something else. So if we just go through these numbers, we can see the first one we have is 5%, and then we get to 6% on their next one, we get to 8%. Now when you go through these, you want to watch the corresponding rise in the prices so you can see what they were trying to accomplish. Now we don't really see anything of significance here. We're on 4%, then we jump to 7%. We did have a rise up to about $9. Now if you notice, we take off into double digits here in about 2006, and the margin changes are just kind of keeping up with the movement of the price of silver. Now here, with silver spiking up to 14 and 15, you can see that they raised it up to 6%, then to 8%, then to 8% again. Well, this is actually, they lowered it, and then we're back to 8% in June when the price of silver kind of came down. So you can see they're trying to kind of find a sweet spot to keep the market from being overheated. So that series continues, and we dip all the way down to 3% as we're rising in the low teens. Then the next significant, well, I wanted to go back to these changes here that we were talking about in 2006. First of all, people have said that what we've seen recently is unprecedented. Actually, it's not unprecedented. If you look, the first rise into double digits was accompanied by an increase on the 5th of April, the 13th, the 19th, the 21st, the 4th of May, and the 9th of May. So within a 1 month period, they raised margin requirements 1, 2, 3, 4, 5, 6 times within a 1 month period. So this isn't unprecedented what we're seeing. Now the next piece of information that kind of stands out from this data set is what occurred in 2008. If you remember, in 2008, this is our closest margin raise near to the Bear Stearns debacle. Well, actually this one here. We had one on the 28th of February and also one on the 5th of March. If you remember, silver took a pretty big run up there, and they raised it up. By raising it, it went from 6% to 5%, so the price is rising pretty fast. Around the Bear Stearns time, we were at 5%, and then the last rise was May, after the price had kind of started falling, and we're at 6% or so. Now then we had the financial collapse. This is what's kind of interesting here. We had fallen from 17 down to 12, and in the midst of this, they raised the margins again to 6,000, which made it 1%, which is the highest number we've ever seen. Then they raised it again. The price is still falling. They raised it again on the 20th of October, which put it at 14%. Then they backed off a little bit in January of 2009. They raised it up about around 9%, and then it started to normalize after that. So the key things that stand out here is, were these rises based on volatility, strictly on volatility? Were they looking at a collapse of the financial system here in October of 2008? Was that what they were looking at, rather than just the price moves? Although 12 to 9 is a 25% price move, but does it justify 14%? I don't know. That's up to you to decide. And the last data set I want to look at is, or the last section of this data set is the most recent ones. Tomorrow's rise in the margin will put us at 9%, which is higher than any other time we've been, except for back here in 2009, when we had this recovery through the financial crisis. So the only other time we've been this high as a percentage is the financial crisis. Now, does that imply that we're going into another financial crisis? I don't know. If this price continues to fall from 35, I can see us easily surpassing this 14% if they don't turn around and lower those requirements. So the jury's still out as to which direction we're going. In some instances, the market has shrugged off these margin requirement increases, and other times it's been taken down by them. So we're going to have to wait and see. I think the jury is still out as to whether or not these margin requirement increases are simply an attempt to rein in speculators. As I pointed out, these aren't margins for speculators, these are margins for hedgers. But if that's all that's behind them, or if there's something more nefarious behind them, I tend towards the latter view, but I just wanted to share the raw data with you so you can make up your own mind. And we'll talk to you next time.